start at a very high level and explain what the TCJA is and what we mean by a sunset. So, the Tax Cuts and Jobs Act was passed in 2017, and it drastically changed the way that individuals and businesses are taxed. So, generally speaking, taxes came down for many of these taxpayers. But the key thing that is important to know today is that many of those provisions that were passed will sunset on December 31st, 2025. So effectively, what that means that in 2026, many of those tax rules will revert to what they were in 2016. And of course, this is unless Congress acts to extend or change the law in some way. So let me address the couple weeks ago we had an election. Don't know if you knew that. I'm sure you're appreciating the lack of commercials. The election, as you know, did change the political makeup of both Congress and the presidency. We now have a Republican president-elect, a Republican-controlled Senate with 53 seats, not 60, and a Republican-controlled House of Representatives, albeit with a pretty slim margin. It's also clear that most of the Republicans would like to see most or all of the tax provisions of the TCJA extended well beyond 2026. However, it's important to consider that any change would require legislative action, which hasn't really been a strength of our Congress in the past. It's also important to note that there are many competing priorities in any administration, and we're starting to hear a little more and more about those each day. And a reminder that there are members of Congress who do care deeply about our national debt and the effect of any further tax cuts on those debt levels. So, given all this backdrop, we still think it's important to walk through the potential changes that could happen in 2026, especially because of two reasons. One, it is our current law, and two, any potential extension would likely be a negotiation of some of these provisions. So I think it's important to know what those provisions are. So for this particular scenario, we're going to choose preparation over prediction. And specifically, I'll go into two different areas of the tax law, changes to the estate tax rules, as well as changes to the income tax rules.
Let's kick it off on the estate tax side.
So let me start with the lifetime estate exemption. So the exemption is the amount that a person can give during their life or at their death without any estate taxes paid out of pocket. So here's a table of the estate and gift tax exemption dating back to 1997. So you'll see it was around $600,000 and it's grown to the current level of $13.61 million here in 2024. You can also see the green line, which is the estate tax rate. This is the tax rate that one would pay if your taxable estate is above those exemption levels, and that's stayed steady at 40% over the recent past. You'll also see right in the middle of the chart a blip in 2010, and that's a year that the estate tax was actually eliminated. Many dubbed this as the George Steinbrenner year, the year that the famous former owner of the New York Yankees passed away and actually paid no estate tax. Now, this next slide will show what is set to happen over the next several years. So you'll see on the left side, the $13.61 million is our current exemption. That is set to go to $13.99 million in 2025. And then you'll see the effect of what a sunset would do on this exemption. So if the sunset were to occur, the exemption would go from about $14 million and cut in half to about $7 million. So as you can see, there would be a lot more of our clients who could have taxable estates if a sunset were to occur and pay effectively a 40% tax.
So Jason, what kind of planning can we do to prepare for this potential?
So I think it depends on, the size of your estate, but I'd split our clients maybe into three different segments, and I'll give you some thoughts on each. So the first segment would be the folks on the far left side of your screen, and those would be maybe with clients with less than $7 million in their taxable estate. And frankly, I think these clients have less to worry about in terms of making a large gift to use up their exemption. Now, that doesn't mean that we don't think that estate planning is incredibly important for these people. It's in fact important for everybody on this continuum. So things like titling and beneficiary designations, even gifting, as we'll talk about a little bit later. But overall, a little less urgency on any action before 2026. The second segment that I'll talk about is maybe on the far right side. So those clients with over $50 million in their taxable estate. And the vast majority of these clients we've already been talking to and talking to their estate planning attorneys as well about whether they should make a large gift to use up their exemptions. So we're talking to them about how much to give, what kinds of strategies, discounts, and as well as any types of trust that we should create to receive these gifts. And we're seeing a lot of clients gifting assets to a particular type of trust called a SLAT, or a spousal lifetime access trust. And finally, the third segment, those in the middle. So think of clients between maybe that $14 million range and $50 million range. And this is the group that requires the most analysis in order to decide how much to gift. And just remembering that not all of the factors that go into that decision have to do with taxes.
So Jason, let's think about the what kind of planning can be done for any of these three segments of clients.
Yeah, so annual exclusion gifting can be a very powerful tool for transferring wealth regardless of the size of your estate. So let's look at a quick example. We have a client here who has 3 children and 3 grandchildren, and they did decide to make a full annual exclusion gift of $18,000 to each child and grandchild each year for the next 20 years. So as a reminder, the annual exclusion is the amount that you can give to any person without affecting that exemption that I've been talking about before. So you can see that from the green line that these gifts almost go as high as $5 million, considering a 6% rate of return. So it can be a really powerful way to transfer almost $5 million out of this one's estate. And remember that these gifts do not have to go outright to an individual. So they can be put into a trust and protected for the long term. These gifts can go into a 529 plan and be used for educational expenses, or even a Roth IRA if the recipient has earned income. So also remember that any gift that you give directly to a medical or an educational institution won't even count towards that $18,000 annual exclusion limit.
Jason, let's shift over to look at the income tax side. If Congress doesn't act, how will the income tax rates change?
Yeah, so on the left side of your screen, you'll see the current ordinary income tax marginal rates, and you'll see they range from 10% all the way up to 37%. And on the right side, you'll see what the rates would be in 2026 if a sunset were to occur. And the first thing you'll notice is that the highest marginal rate goes to 39.6. But this really doesn't tell the whole story, because the actual impact is much different whether you're a single taxpayer or a married filing joint taxpayer. So let's look at the single taxpayer first. And you'll see on your screen a graph, and basically the peach colored shading is where the rate is set to go up, whereas that silver colored shading is where the rate is set to go down. So if we target in on a single filer with a taxable income of $300,000, their marginal rate is actually set to go down 2%, from 35% down to 33%. Now, our married filing joint filers are not so lucky. So as you can see, there's a lot of peach colored shading on this graph, indicating that rates would go up, and in some cases pretty significantly. So if we again target that $300,000 of taxable income, the marginal rate is set to go up 9%, from 24% to 33%.
Jason, we talk a lot about marginal rates. How does this differ from the effective rate, and what things should we keep an eye on as we start to hear Congress negotiating likely on some of these tax changes? What things could impact that effective rate?
Yeah, so the marginal rate is the rate that your last dollar of taxable income is taxed at. So we're in a progressive tax system. So if you're in the 37% bracket today, you don't pay 37% on all of your income, just the amount over the income threshold. Whereas the effective tax rate is really the total amount of tax that you pay over your income. So kind of your blended tax rate. And yeah, there are a couple provisions of the TCJA that would sunset that would have an impact on your effective rate. So here are a couple of those, starting with the top left, which is the standard deduction. And if a sunset were to occur, that standard deduction would be cut in half. So for those who take the standard deduction, that means lower deduction, higher effective tax rate. This also may mean that many more people will be itemizing deductions. So that could also have an impact on your effective rate. Maybe on the other side of the coin, you have the state and local tax cap of $10,000 would be eliminated. So currently, if you add up all of your state and local income and property taxes, you're only able to deduct $10,000 of those on your tax return. This cap would be eliminated. So this would actually have a pretty significant impact on those in higher tax states, Illinois, New York, California, those who pay high property taxes. You'd be able to deduct more of those taxes, which would bring down your effective tax rate in the future. Professional fees would again be deductible if over 2% of your adjusted gross income. So again, the fees that you pay to your favorite wealth advisor could be deductible again in the future. And finally, the QBI deduction, the qualified business income deduction. This is a deduction that many pass-through entity businesses take today, and that lowers their effective rate down in the 20% range. So if there's one particular provision that we have our eye on the most, it's that last one, the QBI deduction, which could effectively increase business owners' tax rates from currently at about 20%. It could go as high as 39.6%.
So Jason, we appreciate that we don't have all the answers on exactly what will likely happen with this sunset of the Tax Cuts and Jobs Act. What actions can people take now to plan, knowing that we may not have all the answers for some time to come?
Yeah, I think it's important to kind of draw back on a couple things I said before in terms of the timing of when these tax changes would have to happen. It would have to happen next year before 2026. So not a lot of time to figure out which one of these provisions will be extended or even applied or allowed to sunset in the future. So I think it's important whenever you're looking at tax planning to do planning over multiple years. So it could be enticing to look at this year's taxes and say, how do I reduce this year's taxes the most that I can? But it's important to also include future years and really understand what your marginal and your effective tax rates are today and what they're likely to be in the future. So maybe you find yourself in a position where you think that your income tax rate will go higher in the future. So that could be, you might be in the camp where maybe nothing happens in Congress and the sunset occurs. So your rate is set to go up, or maybe it's just a realization that we are in a very low income tax environment, generally speaking, right now, and in the future could be higher. So a couple things you could consider would be to accelerate income into 24 and 25. Things like Roth conversions, if you have a traditional IRA, or even accelerating a bonus or accelerating some business income into 24 or 25, or even delaying a large charitable contribution into later years where you would get more benefit. So I think our overall comment is that no matter what happens in Congress, whether the sunset occurs or whether it doesn't, or whether we have some sort of negotiation, we've been here before, and there's a playbook to saving taxes in a post-sunset world.